The market just sent a dangerous signal for silver investors. What if the biggest warning sign in today's silver market isn't the headline you saw this week, but the number almost nobody is checking? Because here's what actually happened. 5 months ago, silver hit a record high. Silver soared from $47 to its first ever break above $100 per ounce, ultimately reaching $116. CBS News. Then it started falling and falling. Silver has underperformed gold since the outbreak of the Iran war, losing roughly half its value since reaching a record high in January. Trading economics. This week it got worse. Silver broke below $60 an ounce for the first time since December. 2 days later, it was trading in the high 50s. Yahoo Finance. Most investors are watching that price tag and panicking, or celebrating if they're waiting to buy the dip. But there's a quieter number sitting underneath that price, a ratio that has only flashed this exact pattern twice before in modern history. Both times it came right before one of the most violent moves silver has ever made. By the end of this video, you'll understand what that ratio is, why it's behaving strangely right now, what happened the last 2 times it did this, and what it actually implies for where silver goes from here. This isn't a prediction, it's a pattern. And once you see it, you'll watch silver completely differently. Let's start with where we actually are, because the headlines have been moving fast. As of mid-June, silver was trading around $70, up over 3% in a single session after news broke of a ceasefire between the US and Iran. Oil dropped. Inflation fears eased. For a moment, it looked like silver was about to take off again. It didn't. By the following week, the new Fed chair, Kevin Warsh, reaffirmed the central bank's commitment to fighting inflation, easing concerns he'd cut rates prematurely under political pressure. The Fed also raised its 2026 inflation projections, and headline inflation accelerated to 4.1% in May. Markets began pricing in 3 separate rate hikes this year. Trading economics. That single shift in expectations did more damage to silver than the entire Iran war combined. Silver dropped below $57, on track to lose 14% in a single week, even as peace talks in the Middle East progressed. Trading economics. Think about that for a second. The war that was supposed to be silver's biggest threat ended, and silver kept falling anyway. That's the first clue that something else is driving this, and it's not geopolitics. Here's the mechanism almost nobody explains clearly. Silver pays you nothing. No dividend, no interest, no yield. When you hold an ounce of silver, your only return comes from the price going up. Compare that to a US Treasury bill right now, paying you a real guaranteed return well above 4%. So every time the Fed signals rates are staying higher or going higher still, it's quietly asking every silver holder on Earth the same question. Why are you holding an asset that pays you zero when you could be earning real money risk-free? That's not emotion, that's arithmetic. And right now, the arithmetic is working against silver. Markets are currently pricing an 80% chance of a Fed rate hike by December, with roughly a 63% chance of one as early as September. Trading economics. That's the hidden cause behind this sell-off. Not the war, not a supply glut. Interest rate expectations, repricing in real time. But here's where things become interesting. Because underneath that price collapse, something unusual is happening to the relationship between silver and gold. There's a number serious metals investors have tracked for over a century. It's called the gold to silver ratio. It simply asks, how many ounces of silver does it take to buy 1 ounce of gold? Over the past 100 years, that ratio has averaged somewhere between 50 and 80 to 1. Right now, with gold around $4,344 and silver in the high 50s to low 60s, that ratio sits close to 65 to 1, depending on the exact day you check. That sounds unremarkable, until you compare it to what happened during silver's 2 most legendary bull runs. At the 1980 peak, silver reached 6.7% of the price of gold. At the 2011 peak, it reached 3.3%. In ratio terms, that means the gold-silver ratio compressed dramatically at both of those tops, falling into the teens in early 1980 and down into the low 30s in 2011. The Jerusalem Post. That compression is the signature of a genuine silver mania. When silver is in true blow-off mode, it doesn't just rise. It rises faster than gold, by a wide margin, and the ratio collapses. Here's the part most retail investors miss completely. Silver just did that. The ratio fell sharply on the way up to $116 in January. And now, on the way back down, it's not compressing anymore. It's drifting back toward its long-term historical average. In other words, the mania phase already happened, and it already unwound. What we're watching right now isn't the start of a new collapse. It's the back half of one that already occurred. That distinction matters enormously, and almost nobody framing this as silver is crashing is making it. History gives us another clue, and it's not subtle. In 1980, silver moved from $10 to $48 in just 4 months. 2 months later, it was back at $10, a complete round trip, gone in under half a year. Goldseek. In 2011, silver rallied to $48 over 8 months, then quickly gave up those gains, falling to $26 within a few months. Roughly a 46% collapse from peak. Goldseek. Now look at this cycle. Silver went from around $47 to $116 in just a few months, before reversing. By late June, it had fallen nearly 47% from that record high. CBS News. Trading economics. The percentage decline is eerily close to 2011. The speed of the initial spike is closer to 1980. But here's what's different, and it's the detail almost nobody puts side by side. At their respective peaks, silver never got cheaper than 3.3% of gold's price in 2011, or 6.7% in 1980. Yet today, even after this year's surge, silver remains valued at a small fraction of gold's price, far below those historic extremes. The Jerusalem Post. That tells you something important. Even at silver's most euphoric moment this year, it didn't reach the extremes of valuation that marked the absolute tops in 1980 or 2011. Relative to gold, this rally peaked. Cheaper. Does that guarantee silver won't fall further from here? No, the data doesn't promise anything. But it does suggest this cycle's blow-off, relative to history, may have been more restrained than the two crashes investors keep comparing it to. Here's where most investors get this wrong, and it has nothing to do with charts. When an asset falls 47% from its high in 5 months, the human brain does one of two things. It panics and sells near the bottom. Or it gets euphoric and buys without checking whether the move is actually finished. Smart money does neither. Smart money watches the ratio. When the gold-silver ratio is compressing, silver outperforming gold sharply, that's late cycle behavior. Greed is peaking. That's historically when caution increases. When the ratio is expanding back toward its historical average, like it's doing right now, that's typically the unwind. Painful, yes, but mechanically, it's the market resetting toward a more normal relationship, not necessarily the start of a multi-year bear market. This is exactly the kind of moment where most investors focus on the price chart and feel fear. But that's not the real story. The real story is in the ratio and what it's telling you about where silver sits relative to its own history. Future scenarios. So where does this go? Let's look at both sides honestly, because no one can promise an outcome here. The bull case: if the Iran ceasefire holds, oil keeps normalizing, and inflation expectations continue easing, the Fed loses its main justification for staying hawkish. Combined with 6 years of physical supply deficits potentially surfacing as delivery delays or exchange tightness, some analysts see a year-end target between $90 and $106. Gold-silver. Under that scenario, even a modest gold-silver ratio of 55 to 60 to 1, well within normal historical range, implies a silver price between $72 and $86, simply based on where gold itself is trading. Gold-silver. The bear case. If the ceasefire breaks down, oil re-spikes, and the Fed signals further hikes, real yields stay elevated and silver could retest $60 to $63 as support. Some Fed officials are already pricing an 80% probability of a hike by December, which would directly extend the pressure we're seeing right now. Gold-silver trading, economics. If this trend of rate hike repricing continues unchecked, the path of least resistance stays down in the near term. If inflation data instead continues to cool, as it did briefly in late June, that pressure could reverse quickly. One possible outcome doesn't cancel the other. They're both live, and the Fed's next move arguably matters more right now than anything happening with silver supply or demand. So what should you actually watch instead of just the price? First, the gold-silver ratio itself. Watch whether it keeps drifting back towards 70 to 80, which would suggest more downside relative to gold, or stabilizes and starts compressing again, which would suggest renewed silver-specific strength. Second, Fed rate hike pricing. Watch the probability of a September or December hike. If those probabilities keep climbing, expect more pressure. If they fall, that's typically when precious metals find support. Trading economics. Third, physical market stress. Delivery delays or tightness on exchanges like the COMEX or LBMA, which would suggest the underlying supply deficit is starting to matter more than rate expectations. Gold, silver. None of these guarantee an outcome, but together they're a far better early warning system than just watching the spot price bounce around every morning. If you're finding this kind of analysis useful, consider subscribing to the Collapse Signal. Every week, we break down the economic mechanisms moving global markets before they become tomorrow's headlines. And if this video is helping you see silver more clearly, tapping the like button helps more people find thoughtful analysis instead of noise. Here's the big takeaway. Silver isn't crashing because of some new hidden catastrophe. It's repricing because the Federal Reserve changed the math on holding a zero-yield asset, right as oil and inflation expectations were already in motion. The mania phase of this cycle, measured by the gold-silver ratio, already happened and already partially unwound. What's left is a market deciding whether this was a brutal but ordinary correction or the start of something closer to 1980 and 2011. The historical data suggests this cycle's peak, relative to gold, was actually less extreme than either of those two legendary blow-offs. That doesn't make silver safe. It makes the comparison incomplete when people use it to predict an automatic crash to single digits. So here's the question. Do you think the Fed's rate path is the real signal here? Or is everyone underestimating the physical supply story underneath it? Would you be buying this pullback, waiting for confirmation, or staying on the sidelines entirely? Tell me where you stand in the comments. Markets rarely reward people who react to headlines. They tend to reward people who understand the mechanism moving the price, long before that mechanism makes it onto the news. The real question with silver right now isn't whether the Fed will eventually pause. It's whether you'll understand the signal in time to do something with it. If you found this analysis valuable, subscribe to the Collapse Signal for more breakdowns like this one. Like the video if it helped you see this market differently, and drop your take in the comments below. And if you want to stay ahead of the next move, the next video on this channel is already tracking the signal that's forming right now.